Welcome to This Explainer. Today, we're diving straight into a massive collision: artificial intelligence meeting the Indian stock market. We've all heard the Silicon Valley hype by now, right? But what actually happens when those algorithms hit Dalal Street? Let's find out. It all boils down to one simple but incredibly high-stakes question. Can AI actually predict Indian stocks with any real accuracy? This single question is driving a total structural shift in investment and portfolio management. We're moving way past the days of relying just on human intuition or basic technical analysis. Now we're in this new era of hyper-adaptive strategies that crunch unbelievable amounts of data in real time to forecast the market's next move. But does it actually work? Well, here's where it gets wild. Large language models, the ones like GPT-4, are literally going toe-to-toe with, and sometimes even beating, seasoned human analysts and traditional machine learning models. When researchers took standardized financial statements, like balance sheets and income statements, and fed them into GPT, the model didn't just stumble through it. It actually synthesized purely numerical data to determine if a firm's earnings were going to rise or fall. Now you're probably wondering, how on earth does a language model do financial math? It's not just a fancy calculator. It comes down to something called chain of thought prompting. By forcing the AI to use step-by-step deductive reasoning, it's no longer just crunching numbers in some mysterious black box. It's instructed to spot trends, calculate key ratios, and synthesize all of that information, literally reasoning its way through the data just like a human Wall Street veteran would. And the macro-level impact of this tech? It is absolutely massive. Get this, between 2018 and 2025, algorithmic trading in India exploded from 30% to a staggering 58% of all trades. That means well over half of the trading volume you see happening out there right now is being driven by automated systems. This isn't just some fringe experimental tech anymore. AI is basically the majority shareholder of daily market activity. But here's the catch. All these super smart AI predictions, totally useless if they aren't fast. And that brings us to the physical hardware required to make these trades happen at the exact right millisecond: the co-location server. In a world where millions of calculations happen in the blink of an eye, being physically located closer to the exchange's matching engine means your trade gets executed microseconds faster than some guy sitting on his laptop across the country. Speed, however, is definitely not cheap. We're talking about a staggering financial barrier, up to 15 lakhs a month just to rent server space, power, and cooling in these co-location centers. 15 lakhs. That astronomical price tag completely locks out the average retail trader. Historically, this has been an exclusive playground reserved only for high-frequency trading firms and giant institutional investors. But, everyday investors aren't just taking this lying down. We're actually seeing a full-on retail revolution finding clever workarounds. Through modern digital broking platforms and authorized data vendors, retail traders are now getting their hands on near real-time data access. Sure, it might not be that microsecond perfect 15 lakh a month co-location speed, but it is fast enough to let them run algorithmic strategies right from their smartphones. You can really see this playing out with massive platforms like Zerodha and Grow. Zerodha has gone all in on building a profitable, integrated API ecosystem. It's incredibly tailored for very active, tech-savvy traders. On the flip side, you have Grow, which has snagged a massive 26% market share. That's over 13 million active clients. And they're doing it by using third-party, no-code integrations like Stratzy. These platforms have essentially democratized AI, letting retail investors backtest and execute expert algorithms without needing to know a single line of code. Okay, so the promise is huge, the tech is there, and it's highly accessible. But let's do a reality check. What actually happens when we pit these high-tech AI predictions against the harsh, messy reality of the Indian market? Let's look at the hard numbers. When you pull the 2025 error rates for major Indian companies, the results are, wildly mixed. For ONGC, the AI nailed it pretty closely with just a 6.11% error rate. It predicted 261 rupees, and the actual was about 246. But then look at Asian Paints. The AI completely lost the plot, predicting a massive 4,038 rupees when the actual price was sitting way down at 2,375. That is a nearly 70% error rate. Ouch. And you can see exactly where things go off the rails over time with Reliance Industries. Early on, the AI's predictions track the actual market price beautifully. But notice what happens after 2020. The AI basically predicted this perfect, smooth, skyrocketing curve for Reliance. The reality? The real market was way more volatile and the growth was much slower.
The model completely missed the nuance of the real world.
So, the big takeaway here is that these models really struggle with sudden market chaos. AI basically just memorizes past data and assumes, hey, this smooth linear growth pattern, it's just going to keep going forever. They smooth out all the bumps. But the real market isn't smooth at all. It's incredibly complex, full of unpredictable external shocks, and these models systematically overestimated performance as the years went on. Which brings us to another huge trend in this space, sentiment analysis. Instead of just crunching numbers, natural language processing algorithms try to quantify human emotion. They scrape thousands of news headlines and endless Twitter threads trying to gauge the public's mood, predicting market trends, based purely on whether the internet chatter is feeling positive or negative. Sounds smart, right? Well, the data shows these sentiment models have a massive blind spot. They consistently skew in one direction. They uniformly overestimate stock performance. Companies like IOC and Cipla saw the highest prediction errors simply because the AI read the mood of the internet and just got overly hyped across the board. The massive trap here is simply human nature. AI struggles deeply to understand context, nuance, and especially sarcasm. Imagine someone tweeting something snarky about a company having a terrible quarter. The AI might log that sarcastic remark as positive engagement. This total lack of nuance raises the chances of misinterpretation, which can trigger algorithmic herding, where trading bots all start buying or selling based on a completely misread public vibe. But look, even with the wild miscalculations and the AI's complete inability to understand a joke, algorithmic trading is undeniably a permanent fixture in India now. And to be fair, it brings some major structural benefits. The data shows it has successfully tightened bid-ask spreads, enhanced overall market liquidity, and significantly boosted daily trading volumes. It has essentially oiled the gears and made the market much more efficient. So, how do we safely navigate this new landscape? The research clearly points to a hybrid future. We absolutely need to leverage the raw processing efficiency of AI, but we cannot take our hands off the steering wheel. We need human judgment. That means no blind trust in automated models, continuously refining algorithms against real-world volatility, and pushing regulators like SEB to ensure fair access and robust audits. And honestly, it demands better financial literacy so retail investors actually understand the algorithms they're trusting with their money. As these AI models continue to grow smarter, faster, and quite literally sit right in our pockets, every single retail investor is facing a profound choice. The technology is here, and it is reshaping Dalal Street minute by minute. So I'll leave you with this. In an increasingly automated financial world, are you going to let an algorithm run your portfolio, or are you keeping your hands firmly on the wheel? Thanks so much for joining me for this explainer, and I'll catch you next time.